Welcome to Wealth Wisdom Works. My name is Alan, and on this channel we talk about all things money, finance and investing. That's also what I cover in my book, The Wealth Wisdom Blueprint, which is available on Amazon. I'll leave a link to that in the description below. Today we're going to talk about exploring different investment options and the pros and cons of that. Before I start, I'm not a financial advisor, so any information I give is for entertainment purposes only and does not constitute financial advice. Always consult a financial advisor for specific advice relating to your individual circumstances. Whether you're a seasoned investor or just starting out, it's important to understand the potential benefits and drawbacks of each investment option before making any decisions. There are several investment options available, each with its own unique set of advantages and risks. In this video, we're going to explore the pros and cons of 4 of the most common investment options: stocks, bonds, real estate, and mutual funds and ETFs. By the end of this video, you'll have a better understanding of the investment landscape and be better equipped to make informed decisions about your portfolio. So let's get started. First of all, stocks. Stocks are a popular investment option for the potential for high returns and long-term growth. They represent ownership in a company and can be bought and sold on stock exchanges. However, before jumping into investing in stocks, it's important to understand the risks and benefits associated with this type of investment. One of the main benefits of investing in stocks is their potential for high returns and long-term growth. Historically, stocks have provided higher returns than other investment options such as bonds or real estate. This is because when you invest in stocks, you're investing in the future growth potential of a company. If a company performs well and grows its earnings, the stock price will likely increase, leading to potential gains for the investor. However, investing in stocks also comes with high risk and volatility. Stock prices can fluctuate rapidly and unpredictably, which can lead to losses if you're not careful. The key is to find a balance between potential returns and risk, and this is where diversification comes in. One way to mitigate risk is to diversify your portfolio. This means investing in multiple stocks across different sectors and industries rather than putting all your eggs in one basket. By spreading your investment across different stocks, you will reduce the impact of any single stock's performance on your overall portfolio. For example, if one stock underperforms, the gains from another stock can help offset the losses. It's also important to do your research and analyse a company's financial health and prospects before investing in its stock. This means looking at company's financial statements, its competitors, the industry it operates in, and any news or events that may impact its future growth potential. It's important to invest in companies that have strong fundamentals and a track record of performance. In short, investing in stocks can be a viable way to grow your wealth over the long term, but it's important to approach it with caution and discipline. While stocks offer the potential for high returns, they also come with high risk and volatility. To minimise risk, it's important to diversify your portfolio and do your research before investing in any individual stock. So whether you're bullish or bearish on the market, stocks can be a viable investment option. Just be sure to weigh the potential benefits and drawbacks before making any decisions. With the right approach, stocks can be a powerful tool for building long-term wealth. Bonds. Let's talk about bonds, another popular investment option. Bonds are essentially loans made by investors to governments or corporations, and they come with a fixed interest rate and a maturity date. One of the main benefits of investing in bonds is their stability and lower risk compared to stocks. They can provide a steady income stream and preserve capital during volatile markets. However, bonds typically offer lower returns compared to stocks, and there's also a risk of inflation eroding the value of your investment. In addition, there's a risk of default if the issuer can't pay back the loan. To mitigate these risks, it's important to diversify your bond portfolio and research the creditworthiness of the issuer. You can also invest in bond funds or ETFs to spread out your risk. It's also important to note that not all bonds are created equal. There are two main types of bonds, government bonds and corporate bonds, each with their own set of risks and benefits. Government bonds, also known as treasuries, are issued by national governments to finance their operations. They are considered to be one of the safest investments available since they are backed by the full faith and credit of the government. As a result, they typically offer lower yields than other bonds. On the other hand, corporate bonds are issued by corporations to finance their operations. They tend to offer higher yields than government bonds, but they also come with a higher risk of default. The creditworthiness of the issuer is a critical factor in determining the risk of corporate bonds, and it's important to research the financial health of the company before investing. Investors should consider their risk tolerance and financial goals when deciding between government bonds and corporate bonds. If you prioritise safety and stability, government bonds may be the best option. If you're comfortable with taking on more risk for potentially higher returns, corporate bonds might be a good fit. It's also important to consider the interest rate environment when investing in bonds. When interest rates are low, bond prices tend to be higher and yields lower. Conversely, when interest rates rise, bond prices tend to fall, which can result in losses for investors. It's important to keep this in mind when investing in bonds and adjust your portfolio accordingly. In conclusion, bonds can be a good option for investors looking for stability and lower risk, but it's important to understand the different types of bonds and their associated risks. As with any investment, it's important to do your research and make informed decisions based on your individual financial situation and goals. Next, real estate. Now let's talk about real estate, another popular investment option. There are several ways to invest in real estate, including buying rental properties, investing in real estate investment trusts, REITs, and crowdfunding. One of the main benefits of investing in real estate is the potential for passive income and long-term appreciation. Real estate can also be a good hedge against inflation and stock market volatility. However, investing in real estate typically requires high upfront costs and can involve management responsibilities, such as finding tenants and maintaining properties. It's important to weigh the potential benefits and drawbacks before investing in real estate. To mitigate risk, it's important to do your research and diversify your real estate portfolio. For example, you can invest in different types of properties or geographic regions to spread out your risk. In summary, real estate can be a viable investment option, but it's important to approach it with caution and discipline. Mutual funds and ETFs. Let's talk about mutual funds and ETFs, which are investment vehicles that pool money from multiple investors to buy a diversified portfolio of stocks, bonds, or other assets. One of the main benefits of investing in mutual funds and ETFs is diversification. By investing in a fund, you can own a piece of many different stocks or bonds, which can help reduce the risk. In addition, many funds are managed by professionals who can help make informed investment decisions. However, investing in mutual funds and ETFs can come with fees and expenses which can eat into your returns over time. In addition, there's a risk that the fund may underperform its benchmark index or other similar funds. To mitigate risk, it's important to research the fund's track record and fees before investing. You can also look for funds with low expense ratios and a strong history of performance. Mutual funds and ETFs can be a good way to diversify your portfolio and take advantage of professional management, but it's important to do your due diligence and be mindful of fees. So in conclusion, we've covered a lot of ground in this video, discussing the pros and cons of different investment options, including stocks, bonds, real estate, and mutual funds and ETFs. Stocks offer higher potential returns but also come with high risk and volatility. Bonds offer stable income and lower risk, but can be vulnerable to inflation. Real estate can provide passive income and appreciation, but require high upfront costs and management responsibilities. And mutual funds and ETFs offer diversification and professional management, but come with fees and potential underperformance. It's important to do your own research and consider your individual financial goals and risk tolerance when choosing investments. What works for one person might not work for another. And remember, investing is a long-term game, so it's important to stay disciplined and not let short-term market fluctuations derail your strategy. So if you're looking to take control of your finances, understand the basics and grow your wealth, then this is a channel for you. Make sure that you like this video and subscribe to my channel to keep up to date with all my latest videos, and let me know in the comments which topics you want me to cover in future videos. Thanks for watching. Check out my book, The Wealth Wisdom Blueprint, and I'll see you in the next video.